All right. Hello, everybody. Welcome to the July Alchemy of Money community meeting. We have all kinds of interesting things to chat with you about today. So happy summer. Wow, it's almost like well into midsummer. And I am thrilled today to be joined by somebody that most all of you know, Nicole Welsh, our Director of Member Services, Research, Analytics, Tech Guru. I don't know, Nicole, what else? I think we need at least 3 or 4 titles for you here at Alchemy. So excited to have everybody here today. And let's just get started with a little bit of chat. If you could post in chat, where are you joining us from? Where are you from? We have members now across the country, which is really exciting. So we're able to really get a good handle on what's happening around the USA. So we've got David from Los Angeles. We've got Stephen Riffesey, who's going to be coming in a minute to join us in about half an hour, actually, from Pennsylvania. Marie from Boston. We got Tampa in the house. Vlad from Baltimore, Texas, New York City. Very good to see everybody. All right. So today the plan is we have some really juicy, interesting data for you. You may know that starting in January of this year, Alchemy has decided to really look and track what is actually happening in agents' businesses at a macro across the country, compile that data in a way that's meaningful, and then present it to you. So we did Q1 data a couple of months ago, and I'm very excited to say that Q2 data is hot off the press as of the end of last week, and all credit goes to Nicole and our team who has put all this together. So I wanted her to join in our call today because, wow, there's just a lot of numbers to talk about. So Nicole, are you ready? Should we dive in?
Yeah, let's do it.
All right. So let's start with helping people understand the scope of the data that you analyzed. So, how many transactions does this represent? Just give us a sense of the sample size that we're working with here today.
Yeah. So we looked at 85 real estate sales businesses that Alchemy of Money works with. And we work with a lot more entities than 85, but these were the ones that we felt we could get reliable data from because they were up to date and having bank accounts and credit cards connected. We felt that they had provided us with income documentation that we felt was reliable. So we really did try to take out all of the ancillary real estate businesses that we work with, rental properties, flips, staging companies, all that. We took that out. And then we took out anything that we felt like was maybe skewing the data because we didn't have everything totally accurate. So we were left with 85. And then we looked at 62,806 financial transactions over the quarter. So over quarter 2. And that represented about 33 states of the 50 in the US.
Yeah, I like that. I know that as we were getting in there, we realized that if we were to present a realistic picture of what is happening in the country, we definitely needed to make sure that the only data that we were using were from members that were really on top of things and had everything together. So if that's you, by the way, thank you very much. Your data is in here. And we appreciate you answering all of your questions in the portal. You've done a great service to the industry. So, okay.
Like me and David in here, you guys helped us out with this one.
Okay. All right. So you're going to call out to people. And Heather from Silver Spring, hello. All right.
Yeah.
Okay. So what did we find? So where does the average Alchemy member fall within MREA recommendations? So tell us a little bit about this slide. What did you find here?
Okay, so first number that we looked at, of course, was just total revenue, total GCI generated by the businesses that we work with. And so we took both the average of the total revenue generated, and then we also looked at the median because we do have outliers. We have some companies making a real lot in revenue and some people that we've worked with that didn't have a lot of revenue generated. So we kind of wanted to just give 2 ideas. So the mean, that's the average. So the average revenue generated across just quarter 2 was $219,200 $281.46. And then the median, so that's going to be that middle number in the sample size. If we just like came in from both sides and took that very middle number, that was $117,398.88.
Okay.
And so, yeah.
Keep going.
Oh, yeah. And so then, of course, like the big number to look at, right? That's the revenue that you generated, but then we take out your cost of sale and all of your expenses, and what are you left with? And so the average gross profit, after cost of sale, average gross profit, so that's after just cost of sale, is $153,689. And then the median gross profit, this is just after cost of sale. I'm sorry, we have not taken out expenses yet, $109,417.14. So gross profit is just total revenue minus cost of sale.
So a lot of numbers already throwing at you in some terms. So when we say revenue, we are predominantly talking about GCI here. Mm-hmm. So, once in a while, some folks have some referral income coming in that is also considered revenue, but by and large, it's GCI. So if we said $219,000 in GCI for the last quarter, that's an average of $73,000 in GCI. So just if you're thinking about how does this compare to what I did over the last quarter, this is what we're finding. Now, we're going to get into some more relevant details in a minute, but at a high level, we were finding the 219. And then I think interesting, average gross profit across the sample size is 153. That, like you said, is after cost of sale, which means that's what people had left to actually pay their bills. So that's about $51,000 that people had left to pay their bills per month. So starting to get into some details. All right. Now, data is only interesting, I think, if there's some comparative time period that we're looking at it from within. So let's go through this slide here that starts to now not only look at the expenses by categories, but also how that compares to 2023 versus Q2 in 2024. So what do we got here, Nicole?
Yeah, so the first big area that we looked at was compensation. And in the MREA model, we kind of have two big subcategories of compensation. So first, you're going to have like your salary, benefits, and payroll fees, and that's going to include like your contract labor in there too, and then your professional services. And so we see that the MREA, so for our like avatar Alchemy members, if we were to take like our average Alchemy member, we would put them in a band of like generating maybe 340 to 640,000 in total revenue over the course of the year. And we are just seeing our members be way, way over in that salaries, benefits, and payroll fees than the recommended amount from the MREA. So MREA would recommend that somebody of that income level or who's generating that much revenue would spend about 9.8 to 14.1% of their gross profit on salary. And we're seeing like 23.7% of, and then even in professional services, a little high. So our compensation total, like we see across our membership, we're spending quite a lot on compensation.
Yeah. So if you're wondering what MREA is, that's the Millionaire Real Estate Agent model, considered best practices across the industry. So just to highlight, so this is a band of people making, in the 340 to 640 GCI range. If you're making more than that, we have another slide for you. So hang on. But what we're finding is, by and large, people are spending more in compensation than the recommendation in the model. And they are also spending maybe a touch less than last year, but barely. And by the way, when we say compensation, if you're wondering, as the owner of the business, is my compensation included in that total? The answer is yes, but only the part that is paid to you via W-2 salary. So that would be relevant if you're an S corporation and you're on payroll yourself and you've got some sort of paycheck coming to you via ADP or something. That part is in compensation. But the money you just sort of transfer to yourself ad hoc or as you need it is not included in these numbers. And Dana posted a question, is this more realistic than the MREA? That's a really good question. I think we will be able to have a better handle on that with more time on the data, though I would say by and large, people are certainly spending more on compensation than they have historically. And I still think we're seeing some folks maybe haven't yet pivoted their salaries and compensation to a place that makes sense based on today's market. So there's a lot in here to talk about.
Yeah, I do think, and I've had that thought, Dana, as well, where, we thought when these recommendations were built, what were people making? And, has that increased with inflation and things like that? We're continuing to pay our people more. We want high quality people. So I do wonder, are these recommendations realistic today to pay, to spend that little of your profit on, or of your revenue on salary? But that's still what the model suggests. So that's the number that we decided to compare off of. But we've had that same thought about whether or not that's a realistic percentage.
Yeah, I think eventually we'll have enough data to be able to make some model recommendations. But for now, we're just tracking the data to see where things show up. Samantha posted a question, then let's keep moving. Then why would that be considered in the totals? Wouldn't the owner W-2 be considered in the profit? Samantha, the portion of your salary that is paid via W-2 is not considered in the profit. That is an expense to the business because it's a W-2 salary. It's in the compensation total. But any additional money that you might transfer to yourself does come from the profit bottom line. There's some nuance in there. It depends on if you've got an S corporation or not. Probably a good offline conversation. Okay, Nicole, lead generation. Let's go to that one.
Yeah. So this was really interesting. So lead generation, we look at two categories for lead generation. So we look at everything that you're spending on listing management and then everything that you're spending on prospecting and marketing. So in quarter 2, 2024, we did see an increase in the amount spent on listing management above the recommendation in quarter 2 of 2024 by a couple percentage points. And then kind of within the range in prospecting and marketing, in the range that we would expect to see as recommended by the MREA. We are seeing an increase in spend on listing management from what we averaged in 2023 to what we see now here in quarter 2 of 2024. And just a slight dip. And I think really within the same range too, around that 8%. We're just a little below that in prospecting and marketing.
Yeah. So I think a good question right now to ask yourself is, this is the data that we're seeing, but what is your spend? So how much are you spending in lead generation? This is one of these categories we love to spend a lot of time in because ideally you're tracking a return on investment almost down to the dollar in this category. So, it's definitely trending higher and more than the model. That, though, could balance out if it's generating more revenue and profit. So this is definitely one of those spots you've got to go into your own business and see what are your numbers and can you explain them and how is that impacting things.
Yeah. And then I do want to say that the slide went away. We have seen a little bit of a different makeup of membership from the end of 2023 until now as well. So some of the businesses that we stopped working with were businesses that were really kind of on the verge of maybe leaving the industry because they were not profitable. They were not generating enough revenue. And we saw some attrition from those types of businesses toward the end of 2023. And we still captured their data in those 2023 numbers. And we've replaced some of that with some really high performing businesses throughout the year so far in 2024. So when you see some nuances in numbers like that, a little bit more in listing management, that could be related to the bit of a change in makeup of membership that we have seen over the last couple of months.
Yeah, and I think where this is relevant is if you're asking yourself, are agents leaving the business? We can say absolutely they are. Anecdotally, through our own experience, we've certainly had members that just have gone out of business. Mm-hmm. And we're seeing that the members who are still in business or are joining the business now are much more profitable and much more successful than the folks that were like hanging on by their fingernails. A lot of those folks have slid off out of the business. And so we're seeing that reset happen in our industry, as is typical when there is a reset, in the market itself.
Oh, Brian has a really good point for Brandon. He said that listings are also staying on the market longer, so they're costing more.
That is a really good point, Brian. I think we will all likely see our listings management number go up in the coming months as that trend continues across the country for, I predict, the next several months. Another good reason to go back to your lead gen spend and see where you are. Are you running really hot so you don't have a lot of room for your expenses to go up because your listings are staying on the market longer, or are you managing that? That's a really insightful point, Brian. Okay, Nicole, now we have another set of data. So this next set of data, this is for businesses performing at a higher GCI level. So what do we have here?
Yeah, so our average quarterly revenue, so this is just 1 quarter of revenue for our members who were on track to get to $970,000 or more in revenue for the whole year. They actually had a revenue this quarter only of an average of $569,420.48. The median number there, so that middle number, is $378,144.30. And then the next two numbers that you see on this list, these are going to be after cost of sale. So once we take away cost of sale, all of the splits that they're paying to the agents on their team and whatnot, then they're left with what actually hit their banks over the course of the quarter, $356,170.78 on average. And then median number there is $269,504. It's a really good quarter, I think, for pretty much many of our numbers, but these folks in particular.
Yeah, it is clear that Q1 sucked, but Q2 was much better for most of our members. The other thing that's interesting, and you can see it here, Nicole, as you dive into this, is we are clearly tracking the fact that across your expense categories and in your profitability, there is an optimization that starts to hit at $1 million in GCI. That when you get to and above $1 million in GCI, things start to happen differently. You bottom line are making more money. Now that makes sense because you're just globally making more money, but you're actually also, something's happening where you're forcing into your organization more efficiencies, more effectiveness, and you're netting more money too. But anyway, I don't want to get ahead of myself. So what did you find here, Nicole, with now this bracket of members? So this is $270,000, tracking for $290,000 or more in GCI. Same stuff as just before, but the percentages are a little different here.
Yeah. First, Marie had a good point about cost of sale. So if we look at these businesses, yes, we are going to see there being a bigger discrepancy, I would say, between that total revenue number and that gross profit number. And that has to do with having a bigger team.
Yes.
And, splits and how that all works, right? Once you have a lot of people under you, you're paying a lot of people out and it never even comes into your bank account. So we do see a bigger discrepancy with these teams that are tracking toward these higher revenue numbers. So that said, when we look at expenses, I would say, salary, benefits, and payroll fees, it's up there. It's high. It's high in our general membership and it's high with this group. A little bit smaller amount of their total revenue or total gross profit is being spent on their professional services, but still a little more than the MREA recommends, and definitely much over in compensation again here. And I think same stuff applies what we said about the general membership.
Yes, it continues to show that one of the biggest areas of management that we ought to pay a lot of attention to is compensation. And this is generally, per a comment earlier, this is not your compensation, remember, for the most part. This is what you're paying other people, runners, 1099, contractors, non-agents, W-2 employees. So I think a good question to assess here mid-year is, how is my staff ratio doing? Am I prepared to go in the back half of the year? A lot of folks really have set their staffing levels at the spring peak market zone. And so their numbers look good, or better anyway, in the spring of the market. But then when the market is in the slower season, it's a real struggle. So now is really an important time to evaluate that, because we all know staffing changes take a long time to work through the system. So any changes you might make now probably are not going to really flow through to your P&L until end of the year at the earliest, maybe not even until the beginning of next year.
Yeah. So then the next category is our lead generation. And this is either over or in range, much like we saw from the general membership, but very interestingly, really significantly higher than what we saw in 2023. So I think that we're seeing these businesses see that 2023 was a tough year and making some adjustments in where they're spending to try to increase business, honestly.
Yeah, we were talking about this, Nicole, right? We were like, y'all need to spend more money on lead generation if you're going to grow your business. And it sounds like you're listening. Like, the spend on lead generation is double what we were seeing before. We'll be really curious to see how this trails through for the entire year, but a noticeable increase.
Yeah. That was part of our recommendation to many people. I think their recommendation was generally right size compensation and spend more in lead gen. So maybe we took half the advice. Compensation hasn't. But I mean, this has been a good quarter, so it looks like this was money well spent.
Yeah. Well, so then let's look and see, what's the net result here? So let's talk about some of the profitability and how that is actually showing up.
Yeah. Oh my gosh. So we have just cannot say enough about how much better this quarter was. And hopefully everybody in this call experienced that, what the numbers are showing us. So our membership ended the year in 2023 with 82.5% of businesses generating any profit at all, and that could mean $1. In quarter one of 2024, it was so tough. Only 55% of businesses had profit at all.
Yeah, that was a sobering number, Nicole. I remember when we saw that, we're like, and this is like $1 profit. Half the people lost money in Q1, essentially.
Yeah. So that was really hard to see, but we have seen our membership really bounce back.
Woo-hoo! Nice work.
Yeah. So now we're seeing 88% of these businesses being profitable, and not just like a little profitable, right? The average profit in quarter one was $9,907.62 for the whole quarter. And in quarter two, that average bumped up to $62,170.86. So just so much better.
And that includes the people that were not profitable, right? So, which is why then this third line, you took out the people that were not profitable at all because they were skewing the numbers, and you got even better numbers.
Yeah. So then if we took out anybody who was not profitable in quarter one, that average of only profitable entities was $41,532.74. And in quarter two, that number is $74,697.63. So
better.
So much better. We're so happy for everybody.
yes, we are.
Better. Yeah. And so then we take these numbers and we can look at profit margin. And Brandon, we always say like a 30% profit margin is pretty healthy, right?
Yes.
So I think we were pretty impressed by our membership when we looked at the end of 2023 and we saw that our average profit margin was 32%. So that was pretty cool to see, but it really plummeted in quarter one and bounced back again in quarter two. In fact, 40.45% profit margin.
Yeah. Really healthy ultimately. And then the profit margin of the top 10% of 52%. So really impressed with how y'all really turned around the year in Q2 from a profit standpoint.
Yeah. So David asked, does this exclude cost of sale paid to the owner? And this is yes. So we calculate the profit margin based on the gross profit. So this is your gross profit margin. So we're taking not the total revenue. We're taking that gross profit number because that's what actually hit the bank. And it's going to exclude the owner's compensation if that owner's compensation is showing up on the P&L somewhere. So that could be some of our members put money that, if an owner has like personal production, they might put that in cost of sale. Some of our members do that. It would exclude that, yes. And then if there's any owner salary, it is also that's being considered, right?
Yes, and there's no doubt that part of the reason some of these numbers generally have bounced back is a lot of people got back into production. So you all that own these teams that got back into production definitely have helped move these numbers in a better direction. I think it's interesting that this average profit of the top 10%, look at that number. So 270,000. I mean, it seems to say what we already know, which is, you don't have to be number one, but if you can get in the top 10% of the market, of the industry, there's a huge escalating profit that happens in that top tier. So well done on that.
Yeah.
A couple more. We're going to bring in Hank for some insight. Hello, Hank. Welcome.
Hey there.
Yeah.
What else you see here?
Yeah, and then
I want to highlight.
I think that it's just important to look at. Also, we wanted to see how the cost of sale was like, what was the percent of revenue? And so we're kind of seeing that up a little bit from 2023. We think that has to do with the changing of our membership. Like we talked about a little bit, we've seen some solo agents drop off, and we have brought on some teams with more cost of sale. We're seeing that reflected in our numbers. So around 30% kind of holding strong throughout this year so far. And then I just always think it's fascinating when we look at listing revenue as a percent of total revenue and sales revenue as a percent of total revenue. And I always think surely this is going to be the time that there's a big difference. And we see a big difference between these two. And like they are almost exactly even every single time we pull this data. So I just always think that's very interesting.
It'll be really interesting to see as the year goes on and all these buyer compensation changes hit in the month of August if this number moves at all. So stay tuned for that. So, well, thank you, Nicole, for all of your work in pulling together this data. Really appreciate you. Thank you. We're going to transition now to Hank. We want to get some of the insights that you have seen. Give us 2-3 minutes of insights. What strikes you from this data? For those that don't know, Hank Sorensen, our financial coach, many of you I know meet with him frequently. How does this track with what you're seeing in your conversations with people? Any additional insights, Hank?
Yeah, we're having a lot of discussions about right sizing. Notice that, on the very first slide or second slide, that payroll was substantially in excess of MREA standards. And there was a question as to whether or not that's normal now versus, what was normal back in 2004 when that MREA model came out. I actually looked at wage growth since 2004, since that question came up, and it doesn't track. The wage growth is not there where it should have increased that substantially, up 10 points over where it should be. So that kind of dovetails with, on a quarterly basis, what you should be doing as a business owner is a quarterly capacity audit. When I say a capacity audit, what I mean is everything that's on your team regarding personnel, software, subscriptions, everything that you're supposed to get an ROI out of. And that does include human beings in your software and your subscriptions. Once a quarter, do a capacity audit and see whether or not you think that you're getting the value on an ROI basis. Not that you're trading a dollar for a dollar. If you pay $500 a quarter for a software, you shouldn't be getting $500 worth of value out of that software. You should be getting somewhere around $1,500 or $2,000 worth of value out of it. Because you should be, as a business owner, wanting to make a return on that investment. Do a capacity audit on your people, your software, your subscriptions, and see whether or not you're using the full feature set of the software and subscriptions, or whether on a personnel basis, whether someone needs to be transitioned off the team, whether you need another human being, or job responsibilities can be transferred within the team. Also, to lower the cost of goods sold and get your profit margin higher. A lot of larger teams I'm seeing could go with a showing assistant model instead of 100% buyer's agents. As a showing assistant model, you would have certain agents with, you'd pay them about 10% of the selling side commission coming in the front door. Don't pay them hourly. Don't pay them a salary. Charlie Munger said before he passed away, if you show me an incentive, I'm going to show you a result. If you're paying someone hourly, then they're just going to show doors as long as they can, and they don't care about whether or not the door closes. If you pay someone per door, they're going to show as many doors as possible, but now they've got an incentive to show more doors. Yeah. So you want to pay them a piece of the action, usually 10% on the selling side, and that's going to encourage them to get the transaction closed as fast as possible. Great. So instead of paying an agent 50 cents on the dollar, now you pay them 10% of the selling side commission. That'll reduce your cost of sale.
Thank you, Hank. Appreciate your insight. So, Hank's got an enormous amount of wisdom. If you're not right now speaking with him on a monthly basis and you need someone to dive into this, please reach out to us. We'd love to get you connected with Hank so that you can go through some more of these numbers. So thank you, Hank. We're going to let you sign off, and we're going to bring Stephen Riffasy back in as we're there's Stephen. Hello, Stephen.
Greetings. Yep. Just muted my or turned off my video.
Okay, we got you. All right, good. So a couple other things I want to point out on these numbers, and then we're going to move to another section of some additional economic data that's important for us to know. One other thing that's interesting is look at this owner distribution number on the very bottom here. So in 2023, and this speaks to, I think, David, Samantha, a few other people mentioned, does this include owner profit? Owner distributions are the additional money you transfer to yourself over the course of the year above and beyond any money coming to you through a W-2 salary, if you have one. If you are filing as an S Corp, you likely have a W-2 salary, you're required to. So if you don't, then all the money you transfer to yourself shows up in owner distribution. What we thought was interesting in 2023 was that folks distributed $192,000, which exceeded the total amount of profit that they made. The total amount of profit that they made was $162,000. So we saw in 2023, people essentially over-distributed to themselves more money than the business made. And for some of you, that's created a tax problem. But the good news is we may be reversing that trend. If you look at Q2 of 2024, the average amount of owner distribution was $48,682, which was lower than the average profit of the entities of $62,170. That's good because you don't want to distribute to yourself more than the business actually made for very long, or you end up creating all kinds of weird issues. So I think, Stephen, it's just telling us that by and large, the story in our agent businesses in Q2 has been a positive story, but let us not get complacent because we still have a long ways to go. And, I think the back half of the year could be, air quotes, interesting as we deal with a lot of stuff. All right, Stephen, we're going to switch now to a couple macroeconomic slides that impact all of this and look forward to some of your commentary. Let's start with this unemployment number. Unemployment in June hit 4.1%. I mean, just it continues to show an extraordinarily low unemployment number now for a number of quarters in a row, which is, interestingly helpful. I think that in the real estate and technology sector, we've seen that number be a little higher. So broadly across the economy, it's still tough to find people, but it's becoming easier if you're in real estate to hire people because there have been a number of more focus layoffs in real estate and also in technology. So sometimes the macro number gives us an overall trend, but if you zoom a little bit more into real estate, I think that's a little bit different. Stephen, this one could be a good slide for you to comment on.
Yeah, and the labor numbers come out this Friday, so we will see if there's any difference trend-wise up or down in the layoffs. And I think layoffs is partly what's sort of keeping this economy so strong is because everybody's got jobs and they're making money. And people who make money spend it.
Anecdotally, we know a number of people who did layoffs in Q1. I texted a bunch of them in the last couple of weeks and said, hey, that person you laid off X number of weeks or months ago, did they get another job? And how soon thereafter? And not everybody got back to me, but most people did and said that person did get another job within a couple of weeks or so of getting laid off. So it does show there's some really good movement in the market, which for anybody who may need to make a staffing change and you're worried about that person and how they may land later, at least in the moment in the economy, there's likely a lot of options. So that's good. GDP, Stephen. So, came in actually a little hotter than anticipated, I think, in this first quarter of 2.8. And, it's still performing pretty well overall, would you say?
I would agree. Yeah. I mean, corporate profits have remained strong. And we will see that actually this week. As of Friday, we had 41% of the 500 companies that make up the S&P report. 78% of them showed better than expected earnings. We've got another 34% or 170 companies that all report this week. So it's a big number of companies coming in. And as long as those expectations are in line or better, then that just says the economy is continuing to be strong.
Yeah. Really remarkable. I mean, for many, many months, we've been talking about a recession, a hard landing, and that doesn't appear to be, at least in the immediate offing. I mean, GDP is a big lag indicator, right? So it's not telling us necessarily what's going on today. But, that number continues to perform well, maybe too well, right? Because if part of the goal here is to get inflation down, we know that maybe GDP being a little bit softer could help. But speaking of inflation, what's your take currently on inflation, Stephen?
Yep. So Feds meet tomorrow and Wednesday. There's no expectation that they are going to make any changes to rates in terms of a cut. The first potential cut, sort of, if you're a bidding man or woman, the month is September, is when most people are betting, not bidding, but bidding. Yeah, bidding on the bet.
Betting and bidding.
Yes, yeah. It's September. So I think we'll probably just sort of them continue to do more of the same. It doesn't look like the numbers come down that much to make them have a rate cut.
It really seems to be following what Powell said at the beginning of the rate increases, or midway somewhere, where he said, look, rates are going to be higher for a lot longer than people want. And then at the beginning of the year, it seemed like people threw out that statement. It was like, no, we're going to see several rate cuts in the year in 2024. That has not materialized, obviously. What's been the biggest driver, do you think, Stephen, of the Fed still to this date not cutting rates?
Well, I think they were anticipating, as did most people, that the accelerated rate hikes that they made in 2023 were going to have an equal reaction in terms of reducing inflation, but that hasn't been the case. It's been a lot slower for a lot longer. But now that they've sort of hit all their rate cuts, things are starting to come down, albeit slower. So it's just a matter of just waiting for this stuff to work through the system and push inflation down.
Yeah, they've been waiting for all the things to align, right? GDP, employment numbers, inflation reports. So, I mean, we'll see. But I read somewhere, Stephen, like the market is essentially priced in almost 100% chance that the rates go down in September. Am I making that up in my mind somewhere? But it seems like it's a very high percentage of predicted markets.
Yeah, I don't know. I haven't seen a number per se, but all the firms that I listen to for their quarterly calls, everybody's putting in there as September is the date we'll see the first rate cut.
Yeah. So I thought this slide was interesting, Stephen. You produced this slide, or Ameriprise Financial produced this slide. It shows the market returns by president annualized.
Yep. Which is
so give us a little bit of color here on this slide. What are some conclusions that you draw as you look at the data back to?
Oh, now you're making me get political. I don't know.
Just using numbers.
Yeah. I mean, well, the bottom line says it all. Sort of, the Republican Congress presidents, are slightly below in terms of average. in terms of Democrats. I mean, maybe that's because Democrats like spending money and using our money for the government to spend money. And when you spend money, ultimately stocks are going to be the beneficiary of that, which could sort of push things up. It doesn't say anything more than that. I mean, it doesn't say anything about debt. It doesn't say anything about interest rates or whatever else happens in that presidency. It just shows returns.
Yeah, this is sort of like a useful but totally unuseful slide at the same time. It's kind of intellectually interesting, but it also seems to indicate it doesn't really matter. Like, by and large, there's other things that are happening that move the markets. Not to mention, ultimately, really, it's a lot about how you as an individual participant in the market manage your affairs that makes the big difference.
Correct.
So I wanted to include this slide because ultimately the way I look at it is I say, look, it's not up to the president. It's up to us to figure out how to manage our money and maximize returns. And I think it's just important for us to remember that as we're in, of course, an election cycle.
Yeah, the thing that we often forget, even currently, is, everybody's blaming everybody. But, sometimes it's the previous administration that put something in place that is now coming to fruition, either good or bad.
Yeah,
so that could be a direct reflection of that slide. That something a Republican put in place is now, the Democrats are becoming the beneficiaries of.
Yeah, and then flip flop back and forth. I thought this slide though was more interesting. It talks about the volatility in the markets leading up to election day.
Yeah,
so
I think this is of those slides. This is probably.
Yeah, I think
line shows election day. The days on the left side are T minus election day, and the vertical axis shows the VIX, volatility index. So as you can see, it goes up, and most times when you see a graph like this, things that go up are a good thing. But in this case, it's not. When things go up, that means the market is very bouncy and is actually losing percentage points. But immediately after the election, things get back to normal. And then that goes directly to what the market likes. The market likes certainty. And if it's uncertain as to who's going to win, corporations don't necessarily know how to position themselves until they know who the winner is. What are the business policies of that particular candidate? And once they've won, then they know what to do.
Yeah, it's been interesting that I think historically companies have stayed out of politics and haven't necessarily publicly made a lot of endorsements for the president. This election cycle, it seems like there may be more companies taking a stand on that. I will see how that plays out. But I think the thing that I take away from this slide is I think we can expect the next 100 days or so to be just a bit volatile in the markets. So, but that is kind of how it works. So nobody should panic about that the market is at any moment in time trying to make macro adjustments and predictions for the future in a highly unpredictable situation. And that's just going to inevitably lead to some volatility this fall.
Right, which goes back to basic principles of investing. If you have a retirement plan with your company, then you should be dollar cost averaging, meaning put money in every week, every other week, or at least per paycheck so that you can ride the ups and downs. And if you're sort of trying to make a bet and you think you have a large sum of money that you want to deposit into the market, it might make sense to wait until, October. You're never going to time the perfect day. But if we see more volatility, you might be able to buy things a little bit cheaper.
And now in summer, July and August is a really important time to be talking with your financial professionals. This is the moment to have a meeting with your financial advisor. If you don't have one, Stephen does great work for many of our members. It's also the time to be meeting with your CPA. I know our tax team for our tax members is proactively reaching out to folks to have a mid-year meeting. So election season aside, the summer is the time to sort of set the strategy for the next 12 months. It's a lot easier to do a lot of that macro strategy setting now, and then maybe make some adjustments at the beginning of the year or at the end of the year versus like this big planning thing at the end of the year when it's already really busy. So I loved, talking about this in the context of what are our financial decisions, individual plans. I mean, Stephen knows, because I've been talking to him, like in my household, we too have been making some decisions about how to reposition the next 12 months. Because I think there's a lot more effectiveness in doing that in the summer. All right, let's zoom back in a little bit now into housing. So this is Goldman Sachs' forecast for home prices, saying that they're expecting things will appreciate by 5% in 2024 and 3.7% in 2025. I find this interesting. I mean, I'm sure they spend an enormous amount of time and money coming up with these numbers, but who the heck knows? I don't know. I think what I take away from this is more really what they're projecting interest rates to be, which is nominally the same. If you look in the middle there, they're like 6, 6.4, 6.4, 6.3, 6.9, 6.3, 6. The 10-year Treasury, which tends to drive a lot of things, just not a lot of change. And it feels a lot like there's nothing on this slide that's telling us that there's a macro unlock of the housing market yet, that it's going to be probably more of the same for longer. What is your takeaway on this, Stephen?
I agree. Yeah, I think until the Feds get to their target rate of 2% inflation, it's going to be a very long time before they're cutting interest rates that, affect pretty much everything, all kinds of borrowing and lending.
Yes. Yeah. New housing starts. So housing starts in the U.S. fell 5.5%. Not super helpful. We're continuing to see challenges in inventory around new housing starts, although more inventory is definitely coming on in certain geographies of the U.S. This is U.S. housing starts by category of single family versus multifamily versus with 5 or more units or 2 to 4 units. If you kind of pull your eyes to the very end of this graphic, you can see, unfortunately, the starts have been trending down in the last few months versus up, which we would certainly like to see more inventory coming on. I mean, bottom line, it's just hard to finance stuff, Stephen. Like builders and investors, are not the deals, the projects aren't penciling out like they once did.
Yep, I think of 2 communities right here in my local area that have been on the books for years. One of them was sort of a multifamily apartment complex with about 180 units. It got tabled again, and down the road of another one with like 230. Mixed townhouses, single families, is still just stagnant.
Now, interestingly, at a macro, we are seeing, this is a resale inventory of the national month supply of single family homes going up a little bit. So from a real low point to still a low point, but a little bit of a higher point. And that's generally a pretty good trend. And this graphic really tells the picture visually, I think. This dark line where it says 2024, this is active U.S. Inventory, clearly above the years 20, 21, 22, and 20, or not 20, I'm sorry. We're almost above 20. We're about to cross above 20, but certainly above 21, 22, and 23. So in many areas of the country, we are quickly accelerating above pre-pandemic levels. I like to remind people, though, that pre-pandemic, it wasn't like there was a lot of inventory. So, we have a long way to go, I think, before all of us are feeling like there's plenty of inventory. Now, this is kind of interesting. This is active housing inventory for sale compared to March 2024 compared to March of 2019. So this is what I was just talking about, that we have a long way to go before inventory has gone to March 2019 levels, with the exception of Texas. You're pretty close. You only have 4% more before you're going to hit that level. Florida, you're climbing quick and are not too far behind Texas. We're also seeing a fairly big rise in inventory in some markets in Arizona. But if you look at some of the Northeast markets, we're well below inventory levels from pre-pandemic. But if you look instead at let's see, not that one, this one here. This is a 1-year change in active housing inventory to see what the current trend line is. And you can see that other than South Dakota and Nevada, we are seeing a dramatic increase in inventory in Georgia, Florida, Arizona, maybe Washington State, the Carolinas, lesser so in the middle part of the country, and even lesser so in the Northeast, with some outliers in like up in Maine there. And so I think what we are clearly seeing in the data is, as the market is shifting and we're going through what would be considered the last phase of this economic shift. The last phase is increase in inventory, decrease in prices, and that has started in the South by and large. And historically, it works itself up into the Carolinas. Then it sort of popcorns around the rest of the country. The Midwest usually is impacted the least because it tends to go up the least. And then the Northeast, Mid-Atlantic sort of lags. So we'll see as this goes on, but we're able to see clearly in the last 12 months, in almost all states, inventory is definitely on the rise. Anything you're noticing from your perspective, Stephen?
Nope, I would support that. I mean, here I'm in outside of Philly, and clients are retiring and sort of moving to different homes, and I've noticed it's taking them a little bit longer to sell their homes.
Yeah,
which is, in some ways a good thing, because I was just reading through the comments. Brian says, listening to stay on the market longer are costing a little bit more. And I can see that clients then often get into a little bit of a bidding war the longer it sits, which is, a good thing if you're a seller.
So the stat that drives a lot of our business actually, though, is the volume of actual home sales. What are the units that are actually being sold? And look, I said it at the end of last year and the beginning of this year, the 2024, we were going to get no help from the market in our businesses. And that continues to be the case. The number of actual home sales happening continues to bump along the bottom at some pretty historic lows. We'll probably end the year with maybe 100,000 more sales in 2024 than we did in 2023, barely anything. We still have a ways to go, well into 2025, I think, before most of us are going to see a noticeable increase in actual home sales as the market continues to adjust. Nevertheless, the median price continues to go up, which we've seen. So, kind of a year-over-year change. This has been remarkable. I mean, with higher interest rates, lower inventory, the prices in many markets continue to go up. But we do have members in Florida and in some markets of Texas who have described to us notable price decreases. So I think that we will definitely see more price decreases. Not in all markets. Like, I'm in Washington, D.C., and even in the last big recession of 2008, 9, 10, the suburbs had some pretty big price decreases, the city less so. So this is definitely, macro changes in people's markets. So it's just good to know, what are your stats exactly? Total existing home sales, sort of a year-over-year change by month. And let's see. Realtor confidence survey that I just want to pull out the very end here where it says days on market. So a tiny increase in days on market. June of 2024, we were a national average of 22 days on the market. And June of 2023 was 18. So you can see that when you zoom out a bit, there's not been a whole lot of change. But if you zoom into individual markets, you're seeing dramatic changes in certain markets, which is moving the average only a little bit. Existing home sales, I'm kind of fast forwarding some of these that are a little less interesting. This is actually, I like this slide here. This is a percentage of change in sales from a year ago in price brackets. So you can see that there is a difference, certainly in the million plus range, than in some of these other brackets in terms of the number of sales happening. So in the upper brackets of the market, we're certainly seeing more listings happening, which I think probably tracks if you're selling in the luxury market. You've seen more listings and things staying out a little longer. Interest rates, Stephen, how do you think the potential change in the Fed fund rate in September might or might not affect mortgage rates this year?
Well, if we get a 0.25% cut, I mean, I know it's not lockstep, but I think that will have a sort of lagging effect to interest rates. I mean, not significantly.
Yeah. Yeah. I think we wish it was a little bit more directly, but it's not. I think that, I haven't seen any actual prediction organizations predicting that rates are going to do much more than move by, 0.25% here or there in the foreseeable future in terms of mortgage rates. This is a little projection for the Fed fund rate. This we probably should take this slide out because it's shown this for like the last 2 years, but it hasn't. This is just saying what they think the Fed fund rate will do. It'll get all the way down to 3.0 or 3.1 by 2026. I find that unlikely, but I guess let's see what happens when the rate cuts actually start happening, and we might have a lot more insight in this in say 6 to 10 months. We like to fill lots of slides in here and get these out to you so you can sort of cherry pick the ones that are most relevant to you. I'd encourage you to definitely also maybe use some of these in some of your listing and buyer presentations. It can be really helpful in explaining the macros. This is house price shifts in the last decade. So, let's take Austin. We know Austin's been hit really hard in this last shift, but if you zoom out just 3 or 4 years, then you've done actually really well. So if you bought in the last 2 years, you've got some challenges, but in pretty much every market across the country, if you zoom out to a 3-year time frame, you're doing really well for price shifts in real estate back 10 years. So continues to show that whether you're investing in the equities markets or you're investing in real estate, it's important to have a long-term play on this. All right, so just a few takeaways here in our last few minutes. We predicted interest rates have not come down much or wouldn't come down much this year, and they haven't. And we're seeing far fewer 7% rates in mortgage, but mostly we're still bumping along the mid 6s to upper 6s, and we'll probably continue to do that. All indicators are pointing in the same direction that we'll probably see some rate cuts that may or may not affect mortgage rates this fall. So we'll see where that is. The markets at the moment seem neutral in terms of a Harris versus Trump presidency, in terms of how that's going to impact the economy, which is interesting. And we see that is not unusual. That is kind of what happens in markets, despite both sides trying to use the data to their advantage. The equities markets certainly have accelerated. But there's some indications, as Stephen and I were just talking about, that this fall could be a bit of a bumpy ride. So, hang on for a little bit of volatility. We are in the final stage of the shift. It'll take another solid 12 months or so to play out. So we should continue to see an increase in inventory across more markets in the country, and we should continue to see some price declines in some markets, which means that all your listings must be priced very aggressively. We're seeing lots of listings kind of hang out on the market. Now more than ever, it's really important to make sure your listings are positioned to sell. And hey, by and large, look, it's up to us. It's not up to the market. We're not expecting any big help or change in the next 12 months from the market. So the success that you're going to have is going to be completely up to you. Stephen, thank you for joining us.
Just quick perspective. So as of 2 hours ago, the S&P year to date is up 14.5, and the Nasdaq's up 15.5. So given all the struggles that you might be seeing in the real estate world, people are making money.
That's great. Great. So good news story in a lot of ways. Back to the data we presented earlier, Q1 to Q2 was much better. I think while the macroeconomics remain very similar in real estate, I think we've just gotten a lot better. And Brian's asked me to go back one slide as I close this off. Here you go, Brian. We've gotten a lot better at managing the environment that we're in. So thank you, everybody. Really appreciate you joining us. We're right on time, and we look forward to seeing you next month. Thank you again to Stephen Ripfisi from Ameriprise for joining us, and then Hank Sorensen and Nicole Welsh on my team. And on behalf of everybody at Alchemy, we very much appreciate your business and working with you. Have a great week. Bye.
Yeah.